Hello and welcome to this session in which we would look at auditing the investment cycle. In the prior session, we looked at the investment cycle from an introductory perspective. We looked at the various investment categories, such as equity versus debt, the various investment classification, trading securities available for sale, held to maturity. We looked at fair value and we discussed how important is fair value. We looked at inherent risk. We looked at business risk of the investment. We looked at determining how do we know whether the investment is risky or not. We looked at some of these factors. Basically, it was an introductory session. In this session, we will dive into the auditing aspect. And before you dive into the auditing aspect, the first thing you do is you review the internal control. You learn about the internal control. You may need to test the internal control to determine whether they are working or not. Then you go in and you start to audit the actual asset, the actual items. And this is what we will do in this session, starting with the internal controls for the investment cycle. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Our audit course is best for online students and students who are struggling in their audit courses. We cover the essentials from audit reports, internal control, ethics, evidence, sampling, planning and materiality, assurance and non-assurance services, and of course, the accounting cycles. Our comprehensive course includes lectures, multiple choice, true-false questions. Go ahead and start your free trial today. We are here to help. Your success starts here.
When it comes to internal control, we need strong internal control just like with any other cycle, especially with a cycle like investment, because investment, it's going to be the closest thing to it is the cash cycle. So internal control is extremely important. And when we talked about tolerable misstatement, you remember we set tolerable misstatement low, just like the cash cycle, because we can practically audit everything, or we should be able to audit everything, assuming we are dealing with publicly traded securities. The first thing we want to make sure we are in control of when it comes to the investment cycle is the initiation part. What's initiation? Who decides when and what to invest in? Who's in charge of the company? A decision to determine whether we should buy Apple computers or AT&T bonds or Walmart's securities. Who decides? Is it the board of directors? Is it the CFO? Why? Because this is where the accountability starts. Who makes that decision initially? 2, making the decision need authorization. Do we have a formal policy for approving investments? Okay, so for example, can the CFO, if the CFO can do it, is it, for example, the CFO can make investments up to 100K, for example, or once it goes more than 100K, we need the board of directors. Is this policy documented? Is it above a certain amount? We need special approval. Those are the things that should be down in writing when it comes to initiation as well as authorization. And after initiation and authorizations are, in quote, approved, what do we need to do is processing. Are investments and sales properly and promptly recorded in the accounting system? Well, who does it? Who's responsible for making sure we are journalizing, we are recording in the general ledger what's need to be recorded so the transactions are captured? It's the processing part. So a good system will track who authorizes the trade, who executed them, and how they are documented, how they are recorded. And by looking at these areas of the internal control, we have a good idea that we are accounting for everything. We know who did it, when, how, and it's recorded. Also, we need to make sure we are in control, or we have control over the fair value measurement. Remember in the prior session we looked at the fair value measurement, and we said the fair value is one of the most important aspect of auditing the investment cycle, because most, not all, most investments are recorded at fair value. So valuing investment accurately is the trickiest part in auditing the cycle. And what's fair value? It's basically putting a dollar amount. It deals with accuracy and valuation. So companies must have clear policies when they value assets, especially when those assets are subject to level 2 and level 3. So why not level 1? Well, level 1 is pretty straightforward. Level 1, the fair value is given to you in a sense that it's a quoted market price of available securities, like stock that's traded on the New York Stock Exchange or Nasdaq. Everyone know the price of Apple. Everyone know the price of Nasdaq, of Amazon, of Walmart, of PepsiCo, of Coca-Cola. But when it comes to level 2 and level 3, and could be level 3 sometime, you might need a specialist or an outside consultant, especially in level 3 with expertise in pricing unliquid or complex investments. So if you have an investment that's very unique, that's not liquid, that does not have a similar asset to it in the market, what you need to do is find someone that's going to help you price this asset. Could be a CFA, for example, chartered financial analyst, could be a specialist. Level 2 is easier. Level 2, you would look at similar asset to yours to value it. But level 3, you might need some special input. So fair value is important. Another important aspect of investment cycle is disclosure. Disclosure means what? Transparency. Telling us what we need to know about the company. Clear disclosure about what type of investments are we dealing with. The strategies. Are we investing to speculate? Are we investing to hedge? Are we investing for the long term? What's our strategy? What is our risk level? How much risk are we willing to tolerate? Certain companies can tolerate more risk than others. If you are a finance company, that's what you do day in and day out. You can tolerate more risk than a real estate company that deals with real estate. They have to protect their asset versus a software company versus a construction company. And we need to disclose if there's any loans backed by investments. We need to let the investors know about this. The users, what we mean by investors. Management also should be fully aware of the risk they are undertaking and disclose in the financial statement how their investments are accounted for and classified. Also, what do we need to disclose is we understand the risk that we are undertaking as a company, and how do we account for that? How do we classify the different investments? That need to be clearly stated. And disclosure is very important. And in case of Enron, for example, Enron disclosed their investment. They disclosed everything, but they did what's called an over-disclosure, over-information. They gave you so much information that the users did not understand clearly the risk involved. So when you disclose, the disclosure has to be clear, useful, not intent to hide. Let's move into the audit procedures for financial statements. There are a series of procedure steps. And each of these steps is to make sure the investments are real. Well, that's important. We are dealing with assets. Existence is important. Properly valued, that's also important. Accurately recorded and disclosed. So those are basically the main objective. And this is what the process would often look like. So you would start by receiving a schedule of investment activity from the client. So what's an investment activity schedule? Basically a list of their assets, the list of their investments. You're getting a schedule of investments activity. This is similar. Think of the bank reconciliation when you're auditing cash. You will start with that. So the audit begins by getting this schedule that includes the beginning balance of each type of investments. What are you starting with? Which is the ending balance of the prior year. If there's no beginning balance, it will be 0. Then you're going to add any purchases and subtract any sales from that schedule. It will be there. Any gain or losses realized, they would, when they make a sale, they would say, okay, they'll have the cost and they will have either the gain or the loss. And ending balances, ideally at fair value, assuming we are using the fair value. Now, why do I say ideally? Because certain investments don't require fair value, like hold to maturities, HTM investments in debt securities such as bonds. You don't need the fair value. Why? Because it's held to maturity. The nature of the investment, you don't need fair value. Therefore, it's not required for everything. It's the hardest thing. It's the most important thing, valuing the investment. But for certain investments, it's in a sense irrelevant. Why? Because if you hold it to maturity, no need to write it up and down when it goes up and it goes down. Why not? Because at the end, you're not selling it. Therefore, marking it to value is not relevant, and at the end, the value would always be the face value of a bond. No one's going to give you more money than the face value at maturity. Well, before maturity, it might go up or down, but you're not selling it. Your intent is held to maturity, therefore ignore the fair value. Now, when you get the schedule, what do you do first? We have the schedule. First, you foot it, you reconcile it, and you foot it. You foot it means you get a calculator, punch in the numbers, make sure you're adding, subtracting everything correct, and you trace it, you reconcile it to the general ledger. So careful auditors reconcile the total schedule with the amount reported on the company's ledger. Simple as just adding it and see if the numbers are in the general ledger. All purchases and sales are accounted for by tracing them to the ledger. They have purchases, they have sales. Look if they exist in the ledger, make sure the figures are correct. Then you compute the ending balances and match the ending balance to the general ledger. Just basically a reconciliation. So ensure the final categories as well, such as trading securities available for sale and held to maturity, are properly reflected in the ledger. Because in the ledger, you're going to have three types of investments. You could have three types. Trading stocks versus available for sale versus HTS. Then what do we do next? We'll get a broker confirmation. What's a broker confirmation? Broker confirmation is the closest thing to a bank confirmation. In a bank confirmation, you receive confirmation from the bank showing you your cash balances. Here you are looking for rather than a cash confirmation, a broker. A broker means what? A broker means coming from the investment firm that's holding your investment. And this is part of the documentation process. So after reviewing the schedule, great. They say we have 100 shares of Apple. We have 50 shares of AT&T, 500 shares of Amazon. That's what they gave us in the schedule. Now we contact the broker dealer, the investment company that hold those stocks, and tell them, tell us if they indeed have those shares. Well, that's what the confirmation would look like. Basically like a bank confirmation where you are confirming the bank balances. It shows the actual asset held at the end of the year and the transaction. They show you the purchases and the sale that they made. Now, bear in mind, since most investments now don't have a physical presence mean back in the old days, back long time ago, investments, you will have an actual certificate. Certificate means you have an actual certificate in a sense that if you own stocks in Apple, you will have a certificate. These days, and you would inspect the certificate, you will touch the certificate, you would see it, you would look at it, you would read it. You no longer have those physical presence. Therefore, a confirmation from the bank, from the broker will suffice for the existent assertion. Why? Because it's a third party. That's the assumption here, and the third party is legitimate. And if the third party is legitimate and they're telling you we have the stocks, existence is there, then we have to accept this. So the auditor must verify that the financial instrument recorded by the company truly exists. Now, let me ask you this question now. Could you claim certain investment and certain fair value that doesn't really exist? Yes, if you're Bernie Madoff. If you don't know who that is, this person conducted the largest Ponzi scheme in history. What does that mean? It means this individual was reporting investments that did not exist and value that was artificially inflated, value that showed that he was making profit. Bernie Madoff. Look him up. Now, how was he able to do so? Well, he was the broker. He was preparing those statements, and he had the auditor. Who was his auditor? One-person operation. It's the auditor that he sent to school himself and paid for their education. So that's fraud. But in the absence of this exception, the broker-dealer is honest because they have no reason to lie to you. So the broker-dealer will send you a confirmation that the securities actually exist, and that's what you need as evidence. Now, physical inspection, again, that's not really necessary because these days no one holds stock certificates anymore. So A broker confirmation will suffice, making the physical inspection very common, and it will take care of the existence. How about completeness? Are we concerned about completeness? Not necessary, but we want to make sure we accounted for everything. Again, the broker dealer will, if you look at the other investments, make sure everything is recorded, will do. So auditor need assurance that all financial instruments by the company are properly recorded. So again, you would inspect and review relevant agreement and contract and confirm all instrument listed in the activity schedule. You compare it to what? You compare it to the broker dealer to make sure if there's something on the broker dealer that's not on the investment schedule, then it's missing. If you're buying a private company, there should be an agreement, how much you paid for it. There should be a contract of some sort. And based on that, you can figure out the initial purchase. Then it will help you with the valuation. Let's go to valuation. Fair value. Auditor must confirm the financial statement listed on the on record are properly recorded. Properly recorded at what? At fair value. If fair value is needed, unless it's held to maturity. How do you do that? Well, if it's level 1, it's easy. If it's not level 1, you want to look at the underlying documentation and agreement to verify that the valuation, if there's interest rate involved, maturity date, and quantity are correct. So you'd look at the documentation. If it's a private company, private deal, you bought a company that's not publicly traded. If it's publicly traded and it's with the broker dealer, easy. They will provide this to you. What are some other key audit assertions and other tests that we need to be familiar with is realizable value. Determine if the fair value are accurate, and specifically here when we say realizable value, we're looking at any impairment losses. What are impairment losses? Impairment losses are losses that are permanent in nature. It means the security went down in value and it's not going to recover. Close to bankruptcy. Or you bought a bond, which is you lend your money to someone, and that company is credit risk. Credit risk means they have high credit risk. It means they are not going to pay you because they don't have the money. So for example, if you purchase $1 million worth of bonds and this company is facing credit risk and now the maximum they can pay you is $200,000, you lost $800,000. You have to write down. So the realizable value becomes $200,000. Even if you wait for maturity, you're not getting the million, you're getting the $200,000. It's a permanent loss in value. You would need to record this. Cutoff is important as well. When, at what point, in which period you record your investment. And classification. Classification is what? Is it trade in securities? Is it available for sale? Is it held to maturity? You would simply ask management. They will, in the schedule, they should separate them, but you would also ask them to make sure that's what they want to do. Because classification is based on management intent, whether it's trading, available for sale, or held to maturity. The only thing we did not talk about auditing is analytical procedures, my favorite technique or my favorite testing, but it's not as helpful for the investment cycle. Why? Because when you have an investment fluctuate a lot. They go up and down. They're volatile. Well, analytical procedures work best when there's a trend, when you can make sense of things, when things are connected. Investments, they fluctuate. You have no control over them. Nevertheless, you could still use them, but not as much as they're not as useful as in other cycles like property, plant, and equipment, like payroll. They're useful when it comes to reasonableness. What do I mean by this? Well, when you're estimating interest and dividend income, well, it's good to use analytical procedures. What does that mean? If the company holds $1 million worth of bonds and the average interest rate overall 5%, you would expect to have $50,000 in interest income. Well, if the interest income is $150,000, you would question that because that's unreasonable. If the interest income is $10,000, you also need to question that because if they have $1 million worth of bonds and the average interest rate is 5%, that's going to be the case around $50,000 in interest income. Dividend income is the same. You would look at what stocks they have. If those stocks pay dividend, that information is publicly traded, and you can estimate this number before you actually get the number. So then you compare the actual income to the estimate, and you would look for any discrepancies to investigate, any expected differences. So in this session, what we did is we looked at the internal control, some of the key internal control in this cycle. Then we looked at how do we verify existence. Again, bank Just like a bank confirmation, we have a broker-dealer confirmation. That's important. We have the investment schedule that's provided. That's part of the documentation that's given from the client. Let's take a look at this multiple choice question from farhatlectures.com. Which of the following would not be included in the schedule of investment activities, in the financial instrument schedule? Would they show the beginning balance plus the purchases? Yes, you have to show the beginning balance of the investment plus what you added to them. Would you have to show the sales of the financial instrument and the associated gain or loss? Just like you'd show the purchases, you'd show the sale, and as you show the purchases and the sale, you can figure out the gain or the loss. So A and B are out. Do you show the ending balances? Sure, of all financial instruments recorded at fair value. You should try to record everything at fair value if you can. Maybe certain investments would be recorded at amortized cost like a HTM, but you have to show the ending balances. So that's also showing. So by process of elimination, D is the correct answer, dividend and interest income. Dividend and interest income will be shown in a separate schedule. You would have some sort of an investment income schedule and you would show the dividend and interest income. Therefore, dividend and interest income will not show in the financial instrument schedule of investing activities. What should you do now? Whether you are an accounting student, a CPA exam candidate, go to farhatlectures.com and look at additional resources, multiple choice, true, false, AI CPA questions, video solution, video simulation. Invest in yourself. That's the best investment you can make. Good luck and stay safe.